Welcome to vTalkInsight, Allocator's Lens Daily for March 17th, 2026. A severe energy shock in the Middle East is colliding with an AI-driven growth story and shifting expectations for rate cuts, while equities remain surprisingly resilient. Today we will connect how that tension is playing out across stocks, bonds, credit, currencies, and commodities, and what that means for the balance of risks in multi-asset portfolios. In equities, the dominant tension is between a deepening energy shock and still surprisingly firm risk appetite. Global indices have come under pressure, with broad benchmarks on track for their weakest month since late 2022, yet the S&P 500 has only pulled back modestly and even rebounded by about 1% when crude prices dropped sharply late last week. That mix of drawdowns and quick rebounds suggests many investors are willing to lean into weakness rather than abandon the asset class, at least while earnings expectations remain robust. Early indications for trading in the United States and Europe are again pointing higher despite Brent crude holding well above $100 per barrel and Gulf supply still constrained. Under the surface, though, liquidity is thin. In Europe, cash equity volumes have fallen roughly 40% below recent averages, and price action is heavily driven by headlines rather than fundamentals. Indices can therefore look calm at the close, even as the intraday path grows more volatile and fragile. Sector performance gives a clearer read on how the shock is being digested. Energy producers are clear beneficiaries of the oil spike, and there is increasing discussion of earnings upgrades for some integrated majors if elevated prices persist. By contrast, European airlines remain under pressure, grappling with higher jet fuel costs and operational disruptions, such as temporary airport suspensions. Many carriers are testing how far they can go with fuel surcharges and higher ticket prices without knocking back already fragile consumer demand. Technology and AI remain the swing factor for equity sentiment. Mega-cap semiconductor names such as NVIDIA, Broadcom, and Micron are still reporting growth north of 30% and securing massive order backlogs, and analysts are lifting expectations for some memory and AI chip makers on the view that the infrastructure build-out extends well into the second half of the decade. At the same time, this capital expenditure intensity is straining parts of the ecosystem. Hyperscalers face hundreds of billions of dollars in long-term lease commitments, and some platforms are cutting headcount to fund AI investment, raising questions about how sustainable the current pace will be if financing costs stay elevated. Flows and positioning show that allocators are not all in on this equity resilience. Institutional investors have shifted closer to neutral, running higher cash balances, tilting toward defensive sectors, and concentrating in familiar large-cap names rather than more speculative growth stories. Retail and high-net-worth activity has reportedly fallen by 20 to 30%, with a tilt toward broad exchange-traded funds and parallel increases in allocations to perceived safe havens such as gold and the Swiss franc. There is still appetite to lean into dislocations, particularly in beaten-up areas like software, where some see scope for a rebound if geopolitical tensions ease quickly. The near-term risk is that weak internals and low liquidity turn any negative surprise, whether from the Middle East, private credit, or central bank communication, into a sharper equity drawdown than recent index moves would imply. Conversely, credible progress on reopening the Strait of Hormuz or a more reassuring tone from this week's central bank meetings could unlock a relief rally as compressed volatility resets. That sets the stage for how rates markets are navigating the same energy-driven uncertainty. In rates, the energy shock is reinforcing a higher-for-longer narrative, even as growth worries build. Policy-sensitive yields in the United States are back near their highs of the past year, and market-implied paths now embed only modest easing over the coming quarters, with some participants again discussing the risk of renewed hikes if inflation expectations keep drifting higher. In the United Kingdom, government bond yields have moved more than 50 basis points higher this month as investors question the fiscal cost of cushioning households from rising living expenses. Across developed markets, yield curves are flattening as short-dated maturities bear the brunt of repricing while longer-dated bonds sell off less. That configuration signals expectations of weaker forward growth and some confidence that supply-side price spikes will eventually give way to demand destruction, even if headline inflation accelerates in the near term. Central banks now face a genuine dilemma. Brent above $100, product shortages in areas like jet fuel and diesel, and rising food and healthcare costs all argue for keeping policy restrictive and potentially leaning more hawkish if the conflict and shipping disruptions last beyond the next month. On the other side, higher energy bills are already eroding disposable incomes. Growth forecasts for major banks have been trimmed, and there are signs of softer industrial activity in Europe, which caution against over-tightening into a potential growth shock. Some disinflationary forces also remain in play, from subdued rental inflation to the absence of the large-scale fiscal stimulus that fueled the last inflation surge. Those cross-currents help explain why some allocators see intermediate maturity duration, particularly in the 7 to 10-year area, as offering a degree of protection if the narrative flips from inflation scare to sharper slowdown. For rates markets, this week's central bank communication on how they interpret the oil shock may be the key catalyst for the next move along the curve, and it will feed directly into how credit is priced. In credit, headline spreads still look orderly, but stress beneath the surface is getting louder. Public investment-grade markets remain open and broadly resilient, yet investors are increasingly using high-yield credit derivatives as tail risk protection, building short exposure in case weakness in risk assets accelerates. The more acute concerns sit in private credit, where some large vehicles have imposed redemption limits and liquidity mismatches are coming into focus. Software exposures are a particular flashpoint. Direct lending portfolios often have more than 20% in software names, many financed at rich entry multiples. With higher rates, slowing growth, and intense AI-driven competition, some of these borrowers may struggle to refinance or grow into their capital structures. Senior recovery rates in troubled loans are being discussed in the 20 to 40 cents on the dollar range, which would force marks lower and could trigger additional redemption pressure. The key question for a cross-asset allocator is how far this stress can spread. One clear channel is via foreselling of liquid instruments. If closed-end or semi-liquid private credit funds face persistent outflows, they may need to raise cash by selling more tradable assets, including high-yield bonds and exchange-traded funds. That scenario has precedent in past episodes where high-yield vehicles briefly traded at steep discounts to their underlying portfolios, creating short-term dislocations but not necessarily systemic crises. For now, some observers view the current scrutiny on private credit as a healthy phase that could improve transparency and underwriting standards, similar to what has happened in parts of U.S. commercial real estate. Even so, the combination of rising funding costs, slowing growth in energy-sensitive sectors like airlines and European steel, and geopolitical uncertainty around certain banks means credit risk premia are more likely to widen than tighten from here. Outside developed markets, emerging market debt still looks relatively appealing on structural measures, such as debt dynamics, especially compared with heavily indebted developed sovereigns. However, the near-term landscape is complicated by wide differences in oil exposure and fiscal space. Exporters and countries with commodity windfalls stand in a very different position from energy importers facing terms of trade shocks and pressure to subsidize domestic fuel prices. That argues for greater country-level differentiation rather than blanket risk-on or risk-off views in emerging credit. More broadly, any intensification of private credit stress or a disorderly move higher in developed market yields could quickly change the balance between carry and capital risk. These credit undercurrents also feed into currency markets, where safe haven demand and commodity exposure are driving sharp divergences. In foreign exchange, the pattern remains classic for an energy-led geopolitical shock. The U.S. dollar is firm, the euro and several other European currencies look fragile, and traditional safe havens such as the Swiss franc and gold are attracting steady inflows. Commentators now expect the dollar's strength to persist and potentially exceed what is currently implied in market pricing, because the United States combines energy self-sufficiency with a central bank that appears in no hurry to deliver rapid rate cuts. By contrast, European bond and currency markets are under strain. German and French yields are probing new highs, while the euro is testing recent lows as investors grapple with stagflation risk and political questions around fiscal support. That divergence reinforces the sense that the euro area is more vulnerable to a prolonged Gulf disruption than the U.S., given its greater dependence on imported energy. Commodity-linked currencies tell a more mixed story. Producers such as Australia and Canada have seen their currencies outperform, reflecting the benefit of higher export prices and a perception of relative resilience. For energy importing emerging markets, however, the combination of higher oil, a strong dollar, and domestic inflation pressures is more challenging, and it feeds directly into debates around fiscal support and subsidy regimes. Another evolving theme is the gradual institutional acceptance of tokenized and blockchain-based versions of traditional financial instruments. Recent regulatory decisions in the United States suggest a cautious openness to such structures, including for money market-style assets, which over time could change how currency exposure is held and traded at the margin. For now, though, the main foreign exchange story remains straightforward. Safe haven demand and energy terms of trade are in the driver's seat, and that dynamic is amplified by what is happening in commodities. Commodities, and energy in particular, sit at the center of today's cross-asset narrative. The Strait of Hormuz is effectively near closure, with most shipping now limited to Iranian or China-linked vessels and only a trickle of tankers attempting alternative routes. Drone strikes on the United Arab Emirates Fujairah port, the key export outlet that bypassed the strait, have halted loadings there as well, removing what had been the main relief valve for global crude flows. As a result, oil supply from major Gulf producers has fallen sharply. Output in the UAE and Kuwait is reported to be roughly half of pre-crisis levels, taking about 10% of global supply offline within a matter of weeks. Various estimates now put the shortfall in the 10 to 14 million barrels per day range, even after accounting for some barrels already at sea and stored reserves that are starting to be tapped. Prices have already responded violently. Brent has surged around 40% this month and is holding above $100 per barrel, while Dubai crude has traded north of $150 and jet fuel prices have spiked toward $250 per barrel in some locations. The situation is especially acute in refined products. There are strategic reserves for crude, but not for gasoline, diesel, and jet fuel, and China's decision to ban exports of key fuels is further tightening global balances and intensifying competition for barrels. Policy responses and alternative supplies are helping at the margin. Releases from strategic reserves, stored volumes from Saudi Arabia and the UAE, and a large one-off waiver that allowed Russian cargoes already at sea to reach market have all provided some offset. The United States is rapidly increasing production, now pumping roughly twice as much oil as any other country and aiming higher, and improved relations with Venezuela are unlocking additional barrels for U.S. refineries. Even with these supports, scenarios in which oil pushes to $150 or more are very much on the table if Gulf shipping remains disrupted beyond the next month. The shock is also radiating beyond crude into a wider set of commodities. Shipping disruptions through both the Strait of Hormuz and the Bab el-Mandeb choke point are affecting liquefied gas, fertilizers, and specialist inputs such as helium and sulfuric acid that are critical for semiconductor production. European gas prices have jumped by about 50% in just a few weeks, squeezing energy-intensive sectors like steel and raising the risk of capacity shutdowns if the crisis extends. Longer term, many expect a structurally higher risk premium across commodity markets as countries move from just-in-time to just-in-case inventory strategies and accelerate efforts to secure supply. Europe's ongoing shift toward renewables, with wind and solar already generating more power than fossil sources in some periods and gas setting the marginal power price less often than in the past, does offer some insulation over time. But in the near term, the combination of elevated energy costs and weaker growth is a textbook stagflation mix. For multi-asset portfolios, that makes the duration of the Gulf disruption and any credible path to normalizing shipping lanes the single most important variable to watch from commodity perspective, and it will continue to ripple across equities, rates, credit, and currencies. Bringing it all together, cross-asset markets are being pulled between the acute energy supply shock and a surprisingly resilient appetite for risk. Equities still lean on strong earnings in AI and energy, but thin liquidity and growing use of hedges point to rising fragility. Rates curves reflect a higher-for-longer stance with mounting stagflation risk, while parts of private credit and some emerging borrowers face a tougher refinancing backdrop. In foreign exchange, a strong dollar and firm safe haven demand underscore the advantage of energy security, even as commodity exporters enjoy a tailwind. Commodities remain the fulcrum. As long as Gulf shipping is constrained and refined products stay scarce, inflation and growth paths will be harder to read and traditional diversification less reliable. For allocators, the key signposts now are central bank communication, any concrete progress on securing Middle East lanes, and how quickly private credit stress evolves. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.